Okay, welcome to part 3 of tonight's Opportunity Zones Meetup. We have been talking tonight in the rest of the program about deal structures, talking about the terms and conditions that go into a contract between an investor and a property developer or a business owner that would both incentivize the investor to put money into the project, but also leave the person who's managing the project with enough outcome to their side to justify going through the pain and suffering of starting a new business. And so we're going to now talk about the topic of control, which is an issue that, again, often is ignored or it's left to the side in a deal. But if you're an investor, the more control you have, the more comfort you have. One of the topics that came up last week in the virtual presentation and in some other programs and in the blog was everyone goes, it's a 10-year deal. Well, 10 years is like leaving the coast in a boat and trying to see where you're going to land it, knowing it's over the horizon. There is no part of the boat tall enough, even on the tallest mast, to see far enough into the future of where you're going to know where you're going to arrive. A lot of investors inherently, instinctively prefer deals where they think they understand what's going to happen, even if they're higher risk, and shorter term is viewed as being shorter risk or lower risk. And so you'll see some investors who go, I'm still doing a shorter term thing because it's more predictable, even if it's got reasons why I might not do it otherwise. And so to do a long-term investment is relatively not done by individuals or smaller groups. Patient capital is almost an extinct term of art, except by insurance companies and large long-term organizations who do money management. So when you're looking at control, this is a big deal from the investor's standpoint in terms of trying to get them to the table. So we talked about this a little bit earlier. A lot of investors want to participate, and sometimes the participation is in the form of voting rights, the ability to select a board of directors or a board of managers, depending upon the entity structure. Sometimes it's the ability to participate in the operation of a business, meaning that they want to see day to day, they want to be engaged, they want to monitor what's taking place. They don't want to go to the sidelines and wait 10 years and come back and hope something good has happened. They would like to maybe be an active participant that can advance the cause of the business or advance the business. And there are ways in which that can be done. We've worked with some crowdfunding situations where we took a customer of the business, we gave them a reason to invest in that business so that they were wearing two hats, both as a customer and as an investor, and then we turned around and gave them sales kits to promote the sale of the products and services of the business, putting on a third hat and accessing the network of that particular person. So the average person has a network of about 200 people, and a correct crowd sourcing, crowd funding type of a program can make every investor an ally and open the door to everyone they know, not only to make another investment, but also to sell the products and services of the company. So participation can take different forms. We've often seen, and it's becoming, I think, a growing trend of investors who look at investing as an adventure. Like, we're going to go out and look for gold. I'm going to invest in this new startup company, and we're going to have a lot of fun. We're going to see drama like they never saw on a reality TV inside the four walls of a brand new startup. And I enjoy the drama, so I'm going to invest in this company. And if they truly enjoy drama, I have a bunch of great projects for them to talk to. But it's a thing that you want to, again, talk to the investor, and particularly prospects in advance. Go, do you care to participate? How do you want to participate? Have some options for them on different things they can do that would actually enhance the business. because if they know people, they can open doors, they can do endorsements of your product or service. These are all valuable to the company above and beyond their investment. In some cases, maybe more valuable than the amount of cash that they can put into the deal. So another one has to do with permissions. A lot of times you'll see an investor give a check to a business, and the business kind of goes off and does whatever it feels like. And the investor feels left out, feels they're not doing what they said they were going to do, there's no accountability. And so you start seeing safeguards built into a lot of investment agreements that say, I'm going to give you money to do real estate for multifamily. I don't want to see you do commercial, so that's a control mechanism. You can't do that without my permission or a vote of 90% of the owners or some such thing. And you're putting boundaries around what the business can or cannot do in order to keep it focused, to hopefully keep it moving. By doing that, you may be taking away opportunities or flexibility, agility, but it gives you a sense from an investment standpoint that at least we're going to be pointed in the same direction. Another thing are conditions. You can't do this unless I say it's okay. So in some cases, you could put together an opportunity zone fund, multi-asset, but before you invest in any particular opportunity, you do a survey of all of your investors. It's in some ways could be a binding survey, meaning it's like a vote of the shareholders. It could be non-binding, where you're simply collecting information. But what you're doing is you're starting to put, again, some boundaries and positions around the investment so that you have a better idea what's going on, or you're at least participating in some of the decision making. It's often good to collect that kind of information, but too many businesses again, fail to take full advantage of what an investor brings to the table. All their experience, all their contacts, all their reputation that they may have. And then exits. This is a topic that we talked about in a prior event of this meetup group. And again, I see it as an ever-growing, more important thing. So you're saying at the end of 10 years, we're going to exit this by conducting a secondary offering, or we're going to buy everybody out with reserves we created during the course of this type of activity. These are all form of exits that are planned rather than being completely market dependent. At the end of 10 years, as we've said, you don't know what's going to happen. So if you don't know what's going to happen, then maybe you would like to put mechanisms in place so there's a way out. And if we go to the last slide, conditions, maybe we say at the end of 10 years, we're going to look at the market and we don't want you to sell off. We don't want you to do secondary offering because the market's in a dump right now. We've got a little more time, so we, the investors, will have the ability to make a call on when this exit can occur. So we've got more control over when the exit's going to happen because this may be slanted to somebody's disadvantage. Or there's less impact there. So looking at these combinations of controls that you can put into a contract can give the investor more comfort. It can make your deal more attractive than the other deals that they're looking at, and it gives them some feeling of comfort. Did you have a question?
No.
Okay. What we're looking at here is just thinking through where are we going to be at in 10 years? Who's going to be in charge? Is the market something that we want to be a little more flexible, adaptable to? Do we want some assured exit, or do we want more flexibility or control over that? And I've talked to a number of real estate people who are just going to use a market things like selling your stock and saying, yeah, you now own stock in a private company. Good luck. You got to hold it 10 years before you can get the tax incentives. We have no idea where we're going to be in 10 years. We have no mechanism to take you out of the stock in 10 years. You're going to have to go out and find your own buyer at that time and your own, whatever. And as much as we're organized to bring you into the deal, we have nothing as far as getting you out of the deal. One of the first things I was taught in doing investments was always to have one identified exit. That would help explain it. And the better rule is to have 3 identified exits. This is our first choice, which may be to be bought out. Our second choice may be to do our own offering or do an offering to take somebody out. Third might be to create a sinking fund to buy back part or all the stock over time, or buy back the original investment and allow the person to continue with a carried interest for whatever the greater value would be. And again, from an opportunity zone standpoint, you're going to have to look at this because the incentive is for the gain on the sale, and if you don't sell all the stock, you won't get all the benefits. So we have to look at it from a tax standpoint as well. But planned exits is something that I think everybody needs to be looking at. And then, as I mentioned earlier, we're looking at the topic of embedding innovation into long-term real estate projects, which is more like a private economic development project that could be a public-private partnership with local government to try to increase the economic activity in the community, not just within the investment, but also in other activities that surround that may impact tenancy, wealth, ability to pay higher rents, other things that would contribute to the real estate project to give it greater value 10 years down the road rather than the customary build and flip within 2 to 4 years. So caps and bonuses. One of the things that sometimes happen is certain projects underperform, and in other cases they overperform. Everybody's going, you're trying to, if you're particularly a business and a tech business, you're trying to convince somebody you've got $1 billion potential standing here in front of you. And today it's early, it's ugly, it's uncertain, nothing's proven, but it might become $1 billion value. So if you put a value on it today based upon the way it looks today, the business owner may have to give up the majority ownership in that particular business, which starts to threaten their incentive to do everything that needs to be done to make it a success, and doesn't necessarily reward them if they make it a great success. So you can put things into the investment agreement that says if you hit a milestone or a valuation, we start shifting ownership. There's a clawback mechanism that allows the owners to buy back 10% for $1 or other things that still leave the investor with a great rate of return, very happy with having made the investment. But we're starting to shift some of the success back to the people who made it happen and do it in a way that, again, works for everybody and makes it all work. Some of these mechanisms are deal structured in terms of dealing with the equity or ownership. Some of them deal with bonuses upon hitting milestones. Some of these may be form of stock incentives where a person upon hitting certain performance milestones can buy stock at the original purchase price instead of today's market value, and that creates a benefit for them. So there's all kinds of things that are done in different businesses that would be looked at here. And part of what we're trying to do is we're trying to make sure that the people who are primarily in charge of making this successful have the incentives to really push this to make it happen. So that brings me to the end of part 3, dealing